As of this very moment, Nuburu Inc., trading under the ticker symbol BURU, is exchanging hands at approximately $0.1988 per share, witnessing a significant intraday decline of roughly 15.40%, with the market actively pushing volatile waves of volume. We are seeing the price oscillate between a low of $0.187 and a high of $0.2266, creating a massive spread that screams volatility. While the broader indices might be treading water, BURU is experiencing a torrential downpour of liquidity and selling pressure, with volume already surpassing 32 million shares, a staggering figure relative to its market capitalization. Expectations for a stock trading at 20 cents are typically abysmal. Most investors scan past this on their Fidelity trading platform or Robinhood app, assuming it is another company on the brink of extinction, destined for the over-the-counter graveyard. The expectation is that this is dead money, a trapped trade for retail bag holders. But the reality is far more nuanced and arguably more explosive. What we are witnessing is not just a sell-off, it is a chaotic repricing of a company attempting a radical pivot from being a simple industrial component manufacturer to a defense technology integrator. The market is currently punishing them for their cash burn, yet the volume indicates that someone, whether high-frequency algorithms or speculative funds, is absorbing millions of shares at these lows. You are not looking at a standard penny stock trajectory. You are looking at a binary event in the making, where the company will either successfully execute its defense pivot or face total recapitalization. When you look at Tesla stock or Apple stock, you are looking at mature, entrenched valuations where the efficient market hypothesis largely holds true. The price reflects known information. But with Nuburu, trading on Interactive Brokers trading screens or via SoFi active investing accounts, you are dealing with severe information asymmetry. The street expectation is bankruptcy or a massive reverse split, which they have indeed discussed. But the reality is that their core technology, the blue laser, is currently being integrated into a defense and security hub through their new acquisitions of companies like Orbit and their partnership with Techni. This disconnect between the financial distress on the balance sheet and the strategic operational pivot is where the opportunity and the danger lie. Let's pause and address the elephant in the room. Why is this stock seeing volume that rivals mid-cap companies? It is because the technology Nuburu owns is not generic. Most industrial lasers are infrared. Infrared works fine for steel, but it is terrible for copper and aluminum, the two most critical metals for the electrification of the economy. If you think about the manufacturing processes behind NVIDIA stock components or the winding mechanisms in EV motors, you are dealing with highly reflective metals. Infrared lasers bounce off them. Blue lasers absorb into them. Nuburu's blue laser technology is physically superior for welding the conductive metals that run the modern world. The market knows this, which is why, despite the abysmal chart, the company hasn't been allowed to go to zero yet. There's intrinsic value in the IP, and that is creating this violent tug of war we're seeing on the tape today. For those of you navigating this through online investing platforms or seeking investment help, it is crucial to understand the structural forces at play. When you use Fidelity Investments or Schwab Intelligent Portfolios, you are often shielded from this level of raw volatility unless you specifically seek it out. Self-investing in microcaps like BURU requires a different mindset than the passive allocation you might get from a SoFi robo-advisor. You need to understand the plumbing of the market. Right now, short interest and market maker hedging are exacerbating these moves. If you're placing orders on Fidelity brokerage accounts or using Robinhood stock trading, you might notice the bid-ask spread widening. This is because liquidity providers are terrified of being caught on the wrong side of a 15% swing in 10 minutes. Let's go deeper into the expectation versus reality of their business model. The expectation is that Nuburu is just a hardware company struggling to sell expensive lasers to hesitant factories. They see declining revenues and think nobody wants the product. The reality, revealed in their recent filings and strategic updates, is that they're moving up the value chain. They're not just trying to sell a laser unit anymore. They're acquiring companies to build a defense and security hub. They recently executed a financial program to support Techni SPA, an Italian vehicle and defense manufacturer. This is a massive shift. They are positioning themselves to be a defense contractor that uses their own laser tech, rather than just a vendor. This aligns them with NATO spending goals and European defense budgets, which is a far stickier and more lucrative market than selling standalone units to random machine shops. But we must substantiate this with the financial grimness that is causing today's drop. The company has received delisting warnings from the NYSE American Exchange. They have proposed reverse stock splits to regain compliance. For a user on Interactive Brokers platform, looking at the Interactive Brokers fees associated with holding such risky assets, this is a red flag. Reverse splits often invite further shorting. The death spiral financing that often accompanies these situations, where a company issues shares at a discount to pay off debt, is a genuine risk. This is why the stock is down 15% today. The market fears dilution more than it loves the technology. The expectation is that shareholders will be washed out before the turnaround happens. The reality is that if the defense contracts from the Techni partnership start printing revenue, the company could re-rate 500% or 1,000% higher from these levels, as their market cap is currently hovering around a tiny $20 to $80 million, depending on the exact share count realization. Now, consider the landscape of investing sites and investing. Most people start with Fidelity mutual funds or Fidelity ETFs to build a safety net, which is smart. Fidelity Wealth Management would likely advise you to stay miles away from BURU. But for the speculative portion of a portfolio, where one might use Robinhood fractional shares or Robinhood crypto for high beta exposure, Nuburu represents a venture capital style bet that is publicly traded. You are not buying a stream of cash flows here. You are buying a call option on the adoption of blue laser technology in the defense sector. Let's analyze the intraday movement we are seeing right now. The stock opened, tried to rally, and was immediately met with a wall of selling. This suggests that there are trapped longs, investors who bought at $0.30 or $0.40 who are exiting into any liquidity they can find. This creates a ceiling on the price. However, the floor is being supported by that massive volume. If this were truly a going to zero moment, you would often see volume dry up as buyers disappear. Instead, we see Robinhood investment activity and Interactive Brokers stock trading volume spiking. This implies turnover. The shareholder base is rotating from frustrated long-term holders to aggressive short-term speculators. This rotation is painful, but it is often a prerequisite for a bottom. I want you to pause for a second and think about the macro environment. We are in a period of heightened geopolitical tension. Defense spending is ramping up globally. Drone warfare, which requires lightweight, highly durable welded components, is the future of combat. Nuburu's partnership with Maddox Defense to advance next-gen drone technologies is the exact narrative that should be sending this stock higher. The fact that it is not going higher tells us that the market currently does not trust management to execute without diluting